Hi there, I'm James Dapperchi, and this is Coffee and a Case Note. Team, today we are going to talk about the incorporation of a special purpose vehicle to become the trustee company of a unit trust in relation to some reasonably valuable residential development. But before we all die of boredom, don't worry, we'll make it through the journey together and hopefully we'll learn a couple of things along the way. Today we have a plaintiff, that's the party who kicks off the proceedings, and the plaintiff is that special purpose vehicle that was incorporated. Our first defendant is a natural person, flesh and blood. That is the person who incorporated the plaintiff, who caused that company to come into existence. The second defendant is the spouse of the first defendant. They are married. The third defendant is the unit holder, similar to a shareholder but different, sort of the beneficiary holding all the units in the unit trust that the plaintiff is trustee of, right? Plaintiff is chasing these three defendants. What's this all about? Now, remember that our plaintiff today is a special purpose vehicle and was incorporated by the first defendant for the purpose of incorporating some residential developments. Now, the first defendant is an experienced residential developer and they have a specific course of conduct that is their usual practice as they find development opportunities that they then pursue. And so what happens is, in this case, the developer, I'll withdraw that, the defendant one, uses their usual practice in this instance, finds a piece of land and goes ahead, incorporates the special purpose vehicle and goes ahead with their usual course of practice, their usual practice in relation to residential developments. That usual practice includes, for what the defendant anticipates to be a short-term development, not opening a new bank account for the new special purpose vehicle. So defendant one will just use their own bank account to run the special purpose vehicle's financial affairs. Similarly, and in accordance with the first defendant's usual practice, the special purpose vehicle will not have a big lot of funds of its own. It won't have a big amount of capital. It'll borrow almost all of the purchase price for the relevant real property, including in relation to relevant taxes and that sort of thing, from a third party lender. And so, in accordance with that usual practice, here we have defendant one causing the plaintiff to borrow a substantial amount of money, about $30 million, from the relevant lender. We'll refer to them as lender, capital L. That $30 million is loaned over to the special purpose vehicle, our plaintiff for today, and the plaintiff goes ahead with the purchase of the property. Now, bear in mind, and I'll just make this explicit, that defendant one is the controlling mind of the plaintiff. They are the sole director and shareholder of defendant three. That's the unit holder in the unit trust that the trustee is trustee of, and they control the trustee as well. So they're exerting a lot of dominion over the way this transaction proceeds, and that is, the evidence suggests, in accordance with defendant one's usual practice for exploiting development opportunities of this kind. Things march along. Shortly after the transaction, the $30 million purchase of the land by the special purpose vehicle, the defendant, the first defendant, causes the special purpose vehicle to lodge a BAS, a business activity statement, on behalf of the special purpose vehicle. This is a thing best understood by tax lawyers and accountants and people smarter and better educated than me. But in short, it's a report on your business activity, and it is something lodged with the specific context of GST, the goods and services tax, borne in mind. Now, as a result of lodging this specific BAS and the specific things that were disclosed on it, a refund or an entitlement to a refund arises. And that entitlement is significant. It's an entitlement to be repaid from the ATO, about $2.6 million. So that's the special purpose vehicle's entitlement to be repaid $2.6 million. But as you'll recall, the special purpose vehicle, in accordance with the first defendant's usual practice, does not have its own bank account. And so that $2.6 million goes straight in to defendant one's bank account. What happens after that is it's transferred from defendant one's bank account into a joint bank account held between defendant one and defendant two. And what happens after that is $9 million from that joint account, which the court accepts contains the 2.6. So $9 million comes out of the joint account. That goes on to purchase a property in Sydney's eastern suburbs for $22 million. that is registered in the name of defendant 1's spouse, registered in defendant 2's name. So let's just go through that again. 2.6 million tax refund goes into defendant 1's account. It's transferred into the joint account of defendant 1 and defendant 2. It's then transferred out of that account as part of the transfer of a big lump of cash in order to proceed with a real property purchase of some value for a Sydney residential property. What the case we're talking about today is a suit commenced by the plaintiff, that's the special purpose vehicle, on the basis that defendant 1 engaged in a breach of trust and that defendant 1 engaged in a breach of their director's duties. Now, what is said by the director is that $1.1 million of this 2.6 was a sort of performance management fee, and $1.5 million of this 2.6 was a performance sort of success fee. It's me being paid for finding this opportunity for the special purpose vehicle. You know, I'm kind of the brains behind this thing. I found the opportunity for the special purpose vehicle, and so I'm taking a fee based on managing the transaction for the benefit of the special purpose vehicle and for my success in managing that transaction as well. The challenge that defendant 1 faces in trying to prove that this was a fee paid appropriately to them is that there's no accounting entry, there's no contract, there's no invoice, there's no agreement reflecting any sort of agreement between the plaintiff and the first defendant that such a fee or fees would be paid and would be applicable. What the defendant, the first defendant, says in that context is to say, well, I determined that it would be appropriate for these fees to be paid in my capacity as sole director and sort of controlling mind of the plaintiff in this context. Now, the real challenge that the defendant has in this context is this lack of evidence I referred to earlier, and indeed the only evidence before the court in relation to whether or not there had been this performance fee or management fee determination was the evidence of the first defendant. The challenge the first defendant faced was a challenge in relation to their credibility. And that challenge was illustrated before the court in relation to dealings between the first defendant and the lender, where the first defendant was cagey and sort of evasive about whether or not the tax refund had been paid, this 2.6 million, and in fact evasive to the point of dishonesty. And this dishonesty sort of told against the first defendant. And what that meant was the court had no evidence before it that would allow it to conclude in favour of the defendants on that particular point. And so what the court found was that the 2.6 million being paid into the first defendant's account and then transferred out in relation to these other transactions was indeed a breach of trust in relation to the first defendant and was a breach of director's duties in relation to the first defendant. A couple of interesting little end notes to follow. The plaintiffs also sued defendant 2, that is the spouse, and defendant 3, that is a different special purpose entity that is the unit holder in the unit trust. Now, interestingly, the plaintiff failed against each of those other defendants, and so the reasons we have before us disclose victory on account of defendant 1, failure on account of defendant 2, failure on account of defendant 3. So as you well know, costs often follow the event in disputes of this kind, and the court has sort of left for another day the question of, well, what are the cost consequences of a party who enjoys victory in relation to what we might think of as the leading defendant, but fails in respect of pursuing those other defendants? But as I say, that's a decision left for another day. I hope that discussion assisted you, and I look forward to joining you again soon for another coffee and another case note. Cheers.